next guest was on our show back in August. He said the U.S. needs to push the Europeans to move more quickly and decisively to deal with the credit crisis. And what did we get yesterday? We got an announcement out of the ECB that they are going to up their swaps, try to backstop the European banks. That's a pretty big deal. The question is whether this is ultimately a positive for the market. Well, helping us try to figure that out, we are joined now by Fred Bergsten, director of the Peterson Institute for International Economics. He's also a former assistant secretary for international affairs at the U.S. Treasury. He's a man we want to listen to. Fred, thanks for joining us. Let me ask you right off the bat, do you like the announcement yesterday, and is this a positive?
Oh, I think it's a positive. It rests, of course, on a negative foundation, the fact that there is some shortage of liquidity, dollar liquidity in this case, in the European financial markets. But it indicates that the Fed and the European Central Bank are on the case. They are in close touch. They are cooperating effectively. And I think this reinstitution of the swap lines will take care of that dimension of the liquidity problem.
You know, Fred, as I talk to traders here on the floor of the New York Stock Exchange, a lot of them tell me this is like throwing good money after bad. You're just going for another sugar high. Do you agree with it? It sounds like you don't agree with that.
No, I don't agree with that at all. It's true that the Europeans have not yet reached a fundamental or lasting solution to the problems of their banks. They are going to need recapitalization. They're going to need to feed more capital, particularly high-quality capital, into the banks to put them on a sound footing for the longer run. But the kinds of things that were done yesterday and the ECB has been doing for the last several months, buy time, and that's necessary now. I think the ECB has clearly indicated that it will do whatever is necessary, in whatever amounts are necessary, to keep the European banking system afloat. They are not going to make a Lehman mistake. They're not going to let somebody go belly up. And the markets ought to be assured that there's never going to be a crisis of that type facing us from the European side.
Fred, there are definitely some parallels here with the U.S., right? We have a central bank that has affirmed that it will do whatever it has to prevent a liquidity crisis. But at the same time, and this seems to be where we are diverging, they're unwilling to really institute any fiscal stimulus at this point. That was something that Treasury Secretary Geithner had on his agenda. What was your perception, or what do you think is going on there? And is that necessary to prevent that region from falling into another recession?
Well, I think there are two things. The Europeans have created this European Financial Stability Fund, the EFSF, which is an embryonic European treasury. It's one step down the inevitable road toward a common European fiscal policy. That's somewhat like the TARP here. That provides funding that can be used along with the ECB to bail out countries, to bail out banks, to deal with crisis situations. So that's a positive thing. It still has to be ratified by the governments, but I think that will take place over the next few weeks, and we'll have in Europe the equivalent of a TARP. So on the financial support side, I think they're actually moving in the right direction and emulating earlier U.S. practice. In terms of macroeconomic policy, I agree with Secretary Geithner. The Europeans need to step up more. Now, the weak Europeans, Italy, Spain, Portugal, etc., cannot do so. They do have to tighten their belts, carry out austerity programs to strengthen their debt positions. But it's the strong Europeans, I think, here who deserve criticism, and that's particularly Germany. Germany is still tightening its fiscal policy when it should be expanding. If Germany, which is under no pressure from the markets, indeed to the contrary, cannot provide stimulus for European growth, then the whole continent is condemned to stagnation for a prolonged period. I think that is the situation at the moment. That is the underlying problem. I do not think we face the risk of a financial crisis in Europe, but we do face the risk of prolonged economic stagnation, and that's where Germany and its few strong northern neighbors, Holland, Austria, a few others, need to step up their game and take at least some short-term expansionary measures.
It seems as if there's some challenges there, though, for those governments to actually gain the political will of the people to do so in the stronger countries. So how are they actually going to make that happen?
No, I think there's a confusion in their politics between bailing out weak countries and banks on the one hand and taking expansionary macroeconomic policy on the other. Those two things tend to get confused, and everything sounds like a rescue of the Greek pensioners. That's not the case, of course. The Germans need to expand their domestic demand to strengthen their own economy. They are slowing down. Their export markets are slowing down, both in Europe and around the world. They need to boost their own growth for purely domestic reasons. Doing so would, of course, then help the periphery of Europe as well and help Europe get out of the crisis. The Germans have an overwhelming interest in maintaining the euro, maintaining the strength of the European economy, and they are the ones who have to provide the economic heft and the growth opportunities if that's going to continue to happen.
Fred, when you were at Treasury, your whole focus was on international affairs. So based on your experience, how strong do you think the commitment is amongst all these nations in the EU right now to actually stand behind their words and support these banks? How strong is it?
I think their commitment is total. I deliberately put that strongly. Even the Greeks, who are having lots of problems with riots in the streets virtually every day, 3 or 4 consecutive years of negative growth, even the Greeks, I think, are committed to stick with it. This is what's called internal devaluations. Greece, Italy to some extent, the other problem countries have lost competitiveness within Europe. Their currencies are overvalued, but they, of course, cannot devalue because they're part of a single currency area of the Europe. Therefore, they have to carry out internal devaluations. Ireland has already achieved about 15%. Little Latvia achieved 25 to 30% in 2 years, and now it's back growing again. It's hard in Greece, in Italy in particular, but I think they're committed to it. They realize that their economies are going to shrink by 15 to 25% over a 2 or 3 year period, but I think they realize the alternatives are even worse. So with fits and starts, kicking and screaming, I think it's going to happen.
Fred, you mentioned fiscal union a moment ago. Some other people, I guess, in the extreme have called it the United States of Europe at some point. Do you think that we actually get there in a year, in 2 years? What kind of timeline would you put together for something like that?
No, I do not think it can happen in 1 or 2 years. It's going to require a new treaty among the Europeans. It may require constitutional changes inside some of the European countries, including Germany, to authorize them to participate in it. I think it's more like 5 years or even longer that it's going to take to do this. What is crucial, I think, for the markets and for the shorter run is 2 things. One is that they get on a clear path in that direction. They've already started creating the European Financial Support Facility. I think they will increasingly take steps that will indicate a path toward fiscal unification to go along with monetary unification, and that will be reassuring. But it'll still take 5 years or more. In the meanwhile, they will have to have interim devices that will tide them over. And that's mainly the European Central Bank basically lending to governments, to banks as necessary to keep the financial system afloat. That may build up a very big balance sheet at the ECB, like we've seen here with the Fed. But I think that's the 2-track strategy. Get on a path toward fiscal union and make clear, credible steps toward it. In the meanwhile, the central bank to carry the day.
All right, Fred, you make it sound a lot easier than it seems to be, but I do appreciate you joining us here on Streets Where we got to leave it there. Thanks so much, Fred Bergsten, director of the Peterson Institute for International Economics. Okay.